something that goes all the way back to the late 1950s, and it really is crucially associated with development in this city of the Eurodollar market. It goes back to the decision on the part of British merchant bankers to switch their allegiance from the British Empire to the American Empire, to switch their allegiance from sterling to gold. They do that in 1957 at the time that there are restrictions on the use of sterling right after Suez. The Americans putting pressure on the British for financing trade, the trade of what had been the sterling zone. And they switched to the dollar, and from the beginning, once you get that unregulated market, beginning in currency market, you inevitably are going to get, because although there's a cartel, there's also competition. You are going to get competition over trading in assets. Secondly, now of course this explodes in 1980. I totally agree that the tendencies are there, grow enormously, as Peter himself showed. They go on fixed exchange rates and the tied gold is very good. But secondly, and more important, we need to understand that what went on since the 1980s was a massive expansion of the money supply, of what was called M3. It's totally ironic. It's like the neoliberal irony, that neoliberalism is kicked off by monetarists who are talking about restricting the money supply. There's a vast expansion of the money supply, of all kinds of financial instruments which are near money and are totally tradable. And that's what goes on. And that produces, as democracy told you, inflation. But it doesn't produce a price inflation because of the defeat of trade unions. It produces an asset inflation. Finally, with regard to that point, very important, it's not an either or a matter. Ricardo just said it. Thomas said it very well. It's not a matter of financial speculation, bubbles, asset inflation, and no real accumulation. They both went on simultaneously. The bubble got so big because they kept adding pieces of bubble gum. They weren't just blowing hot air. And that's what made it so big. And this is very important in terms of the capacity of the American empire to meet this challenge. Because the notion that there has been no real accumulation in the United States, or very little real accumulation in the United States, despite the travails of the auto industry, etc., is wrong. If you look at the enormous accumulation that has taken place in the revolutionary advanced sectors of the economy, the United States is far in advance of the rest of the world. Now, why that's so important is that it's similar to the Depression. Precisely similar in terms of the ability of what already happened in the United States, with the roots of Fordism in the first part of the century, to be the basis for what the United States was then able to do after the Depression, once it got out of the Depression with the Second World War. So there was a growth in the real economy. We need to look at this, and it's very important. Secondly, with regard to the subordinate class, we need to recognize, since the conference is called Many Marxisms, the enormous weakness of Marxism, classical Marxism, totally classical Marxism, in its inability to understand the extent to which the subordinate classes could be integrated into the financial system. They had no sense of it. Hilperting's finance capital couldn't imagine the extent to which the masses could be integrated into the financial system. This was already visible in the United States by the time Hilperting wrote because of the mass of farmers. Martin has written his thesis on this, the way in which small farmers, who were essentially small businessmen in American agriculture, were dependent on the credit system. That put them into conflict with the banks, but it also made them totally dependent on what it is. And the working class by the 1920s was already heavily engaged in consumer credit. Of course, after the Second World War, it exploded enormously. This is really important in terms of understanding mass relations, in which we can't go back to classical Marxism. We have to go beyond it if we're going to understand that. And in terms of understanding the current crisis, this relates to social democracy, which I see the left wing of the Democratic Party as being totally identical with, especially today, given the way European social democracy is involved. And this is very important for what is going on here and has gone on here in terms of the marketization of the European economy and the British economy. The left wing of the Democratic Party, once the crisis of Keynesianism emerged, and the Great Society programs could not be maintained, decided that the way they could continue to serve and meet the needs of the subordinate classes, and especially the black subordinate class in the United States, the African-American subordinate class, was to get them into markets even more. That portion of the working class that has been excluded from them should be included in them. And the Community Reinvestment Act of the late 1970s, which was pushed by a very left-wing Democratic Congress under Carter, forced banks in the United States to lend to those, that area was called the red line of the cities in the United States where the African-American community live. Every bank in the United States opposed that act. Only one from Chicago, a small bank in Chicago, was in favor of it. And of course, they had to do a deal with the banks in order to get that act through. The deal they did was that Fannie Mae and Freddie Mac would create this enormous secondary market in mortgage securities. It already existed, but Fannie Mae and Freddie Mac really took off. This didn't go anywhere because of the downturn of the 80s, the downturn of the 90s. By the 90s, with the recovery of real estate after the downturn of the 90s, it exploded. And Clinton, the black president over there, really pushed it. Produced amendments to the Community Reinvestment Act, and was very popular amongst the black business class in particular for doing this. And when Bush got in, got every shyster involved in the secondary prime mortgage market that could possibly involve, and reduced enormously the amount of capital that Freddie Mae and Fannie Mac as a whole. I agree with Peter that one can't look at this crisis as coming out of as being fundamentally caused by the subprime crisis. It was triggered by it. It's not surprising it was triggered by it, where the Achilles heel of the American system has always lain the inability to integrate the black working class into that system. It's not surprising in fact. Third point. Whatever's happening now is unlike the New Deal in one fundamental sense. It's already been said by the panelists. The New Deal separated commercial and investment banks. It created a firewall between them. If you walked into a bank, you wanted to open a bank account, and your bank manager said, you don't do that. We've got this great investment in gold in Brazil. Put it there. Right? You'll make a lot more money. That became illegal. Right? With SIBI, the competition and integration of banking since the 1960s, it became impossible to maintain that distinction. And they finally did away with it at the end of the 90s, but it was largely been gone by that point. The current trend in terms of regulation, the second New Deal regulation of American banking, will involve the integration of the banking system, so that the investment banking function can indeed rest on the borrowers, on savings deposits. And that's the way they've already moved. They were intending to move in this way before the crisis. Now the question is, what progressive reforms will a second New Deal have with their insurance? And I'm of the view that there will be substantial reforms under the Obama administration, especially in labor legislation. I think they will get the labor legislation through, and American union density will go up, including, especially in the service sector, where there will be unionization. And that will produce new contradictions in the system, although they'll want it for a while because increased wages, especially in the service sector, are needed in order to solve the fundamental contradiction of where the hell are people going to be able to consume from, insofar as they can't get consumer credit anymore, and they can't be taking second mortgages out to keep their credit line. So I think we're going to see that, and you'll get this very quite diversified type of new regulation. Thirdly, on the question of the global economy and American empire, it seems to me, rather than saying the American empire is weaker or not weaker, we don't know. What we do know is that it faces its greatest challenge. And it's defined in terms of this meeting that's going to be held next week. The American state was very successful in integrating what I call Canadianizing the Western European states after World War II. It now faces the problem of integrating the G20, or they may even call it the G12. That is, those states of the South, which are very large and very crucial to global capitalism, China, Brazil, perhaps South Africa, India, probably Indonesia. This is crucial. And the greatest challenge, and maybe a greater challenge than the old empires faced, was their colonies. And will you be able to integrate these independent things into the management of global capitalism under the aegis of the American Treasury and Federal Reserve, et cetera? That's an enormous challenge. We'll have to see whether they're capable of it.
Thank you.